On Friday, oil crashed 10% in a single session, the biggest single-day drop since the crisis began. Stock markets across Asia surged. The Kospi jumped. The Nikkei followed. Investors exhaled for the first time in nearly 2 months. And then, within 48 hours, it all reversed. Iran closed the Strait of Hormuz again. The US Navy fired on and seized an Iranian cargo vessel in the Gulf of Oman. 0 tankers passed through the waterway on Sunday. And this morning, Monday, April the 20th, Brent crude is back above $95 per barrel. In the span of 3 days, the oil market swung more than $20, from near 90 to above 100, back toward 90 and surging again. If that feels chaotic, that is because it is. And chaos of this kind does not just affect traders in London and New York. It reaches into every fuel station, every factory, every household budget across Asia. This is not a distant story. This is yours. Here is what we are going to cover today. We are going to explain exactly what happened this weekend, the full picture, not just the headlines. We are going to show you why Asia is caught in the middle of a tug of war that it did not start. And we are going to walk through 3 clear scenarios for what happens next, and what each one means for markets, currencies, and the stories analysts are watching across this region. Let us begin. A quick note before we begin. Everything in this video is for educational and research purposes only. Nothing here is financial advice. I am not a licensed financial advisor. Please do your own research and speak to a qualified professional before making any investment decisions. The timeline starts on February the 28th, 2026. The United States and Israel launched coordinated airstrikes on Iran, killing its supreme leader. Iran's response was immediate. It closed the Strait of Hormuz. Tanker traffic collapsed by 95%. Brent crude, which had been trading around $70, spiked to a peak of $119.50. That is a 68% move in under 2 weeks. For 7 weeks, the world's most critical oil choke point, a 33-kilometer gap through which 20% of global oil and gas normally flows, has been either fully closed, conditionally open, or violently contested. On April the 8th, Pakistan brokered a 2-week ceasefire. Markets celebrated. Talks began in Islamabad. They failed. The US imposed a naval blockade on Iranian ports on April the 13th. Then came Friday, April the 17th. Iran's Foreign Minister, Syed Abbas Araghchi, declared the Strait of Hormuz open to all commercial ships during the ceasefire between Israel and Lebanon. Oil crashed, markets surged. Brent crude, after settling on Friday at its lowest level since March the 10th, plunged on the news Iran would reopen the strait. But the celebration lasted less than 24 hours. Iran said Saturday it had reinstated control of the Strait of Hormuz, reversing course on its decision to reopen the critical waterway until the United States completely lifts its blockade of Iranian ports. Then on Sunday, the situation escalated further. The US Navy fired on and seized an Iranian-flagged cargo vessel that tried to bypass its blockade in the Gulf of Oman. No tankers passed through the Strait of Hormuz on Sunday, according to tracking data. Speaking on Truth Social on Sunday, US President Donald Trump accused Iran of violating the ceasefire agreement, but confirmed that US negotiators, including Vice President J.D. Vance and Special Envoy Steve Witkoff, would travel to Pakistan on Monday for another round of talks. Iran's parliamentary speaker and chief negotiator, Mohammad Bagher Ghalibaf, said it was, and I quote, impossible for others to pass the strategic strait without Iran's consent. And this morning, with talks in Islamabad either happening or not happening, depending on which hour you read the news, Brent crude is trading above $95. The 52-week trading range on this commodity is now $58.50 at the low to $119.50 at the high. We are in the middle of that range, but the direction of travel right now is upward. This is not a story about the United States and Iran. This is Asia's story, because Asia is the one paying the bill. Let us go country by country, because the exposure varies and the stakes are different everywhere. Japan sources close to 90% of its crude oil from the Middle East. South Korea sources about 70%. These are not marginal dependencies, they are structural. Japan cannot function without Persian Gulf oil. South Korea's entire semiconductor and automotive complex, the industries that powered its extraordinary stock market rally, are built on energy that flows through a 33-kilometer choke point. Since the war began on February the 28th, the Kospi has fallen as much as 16% at its worst. The Nikkei fell as much as 10%. At the Kospi's worst session, Samsung Electronics fell nearly 12%, and SK Hynix fell around 10% in a single day. These are two of the most important technology companies on the planet, not just Korean companies, but the companies that make the memory chips that run the global AI revolution. Lorraine Tan, Asia Director of Equity Research at Morningstar, said the Kospi's decline was partly driven by, quote, growing concern that the AI data center adoption pace might slow due to its significantly higher energy costs than regular data centers. Think about that. The AI boom that was powering Asian markets just 6 weeks ago is now being slowed by energy costs driven by a war in the Middle East. India presents a different but equally serious picture. Almost half of India's crude and 60% of its natural gas flows through the strait. The Indian rupee has weakened to around 93 against the US dollar, a significant depreciation that affects every Indian expat in Singapore sending money home, every NRI investor watching their real returns erode. For Southeast Asia, the story is one of reserves running down. Vietnam holds around 20 days of fuel supply. Indonesia holds around 21 to 23 days. But here is the second domino, and this one is less visible than oil prices. Every time this story gets covered, people focus on fuel. But fuel is just the first consequence. The second consequence is fertilizer. Around 30% of globally traded fertilizers transit the Strait of Hormuz. When the strait closes, fertilizer supply chains break. When fertilizer supply chains break, food production costs rise. And when food production costs rise, in economies where 40% of household income goes to food, the inflation hits ordinary families at the kitchen table, not just investors watching screens. This is not a Middle East crisis. This is a cost of living crisis for 4 billion people across Asia. Here is where things stand right now, as of Monday the 20th of April, 2026. The second round of US-Iran talks is supposed to begin today in Islamabad. Whether it actually happens is unclear. Iranian President Masoud Pezeshkian said in a phone call with Pakistan's Prime Minister that the US blockade of the strait is a violation of the ceasefire agreement. Iranian state media, without naming sources, suggested the talks may not happen at all. Iran's parliamentary speaker Ghalibaf said on Saturday that major differences remain despite some progress toward a deal. The central standoff is a classic double blockade. Iran blockades commercial shipping through the strait. The US blockades Iranian ports. Each side accuses the other of violating the ceasefire. Each side is waiting for the other to blink first. The ceasefire expires on Wednesday, April the 22nd. That is 2 days from now. If no extension is agreed, the ceasefire ends. If the ceasefire ends without a deal, the full conflict resumes. And if the conflict resumes, the strait stays closed, perhaps indefinitely. U.S. Energy Secretary Chris Wright said on Sunday that U.S. gas prices, which reached a national average of $4.05 per gallon, may not return to under $3 until next year. Former Biden administration energy advisor Amos Hochstein captured the stakes clearly. Speaking on Sunday, he said, and I quote, "No matter how the war ends, the Iranians now have a card they never had before," pointing to their control over the Strait of Hormuz. That card. The ability to disrupt 20% of global energy supply at will. Iran now knows it works. The world knows Iran knows it works. That is the context for what comes next. The next 48 hours may be the most consequential for oil prices, Asian markets, and the currencies in your pocket since this crisis began. Here is what analysts say the 3 scenarios look like. The green scenario. The ceasefire extends. Talks produce a framework. This is what the market briefly priced in on Friday afternoon. When Iran's foreign minister announced the strait was open, the Kospi surged almost 7%. Japan's Nikkei gained 5.39%. India's Nifty 50 rose 3.65%. AirAsia surged 6.9%. Qantas rose 10%. Cathay Pacific jumped 4.7%. That single afternoon gave you a perfect preview of what a genuine deal looks like in market terms. In the green scenario, analysts note that Brent crude would likely fall back towards $75 to $85 per barrel as tanker traffic resumes and Gulf production shut-ins unwind. The EIA had estimated that Iraq, Saudi Arabia, Kuwait, the UAE, Qatar, and Bahrain collectively shut in 9.1 million barrels per day of production in April. That supply comes back into the market rapidly once the strait opens. The iShares MSCI South Korea ETF, ticker EWY, moves inversely to oil prices, and nearly 50% of the fund is Samsung and SK Hynix, whose AI chip business is structurally strong. The iShares MSCI India ETF, ticker INDA, benefits from lower energy import costs, unlocking India's growth story. Currency pairs to watch. The Korean won against the US dollar is the most sensitive to oil price changes in the region, followed by the Indonesian rupiah. A confirmed deal would strengthen both materially. The sector that wins most directly in the green scenario, Asian airlines. The sector that loses, tanker operators who benefited from the crisis premium. As always, past performance does not guarantee future outcomes, but the Friday rally showed you the direction and the magnitude when sentiment shifts. The yellow scenario. The ceasefire extends but no full deal emerges. The double blockade continues. This is the base case that most professional analysts are working with right now. The EIA, in its most recent short-term energy outlook, projects Brent crude peaking at $115 per barrel in the second quarter of 2026, under a scenario where disruptions gradually ease. The Dallas Federal Reserve published analysis suggesting that a closure lasting 1 quarter would lower global GDP growth by 2.9 percentage points annualized. That is not a recession for everyone, but for energy-dependent Asian economies already running thin margins, it translates into slower growth, higher inflation, and central banks caught between two bad choices. In this scenario, analysts note that Malaysia stands out as a relative outperformer within Southeast Asia because it is a net energy exporter. Its currency, the ringgit, and Petronas-linked equities benefit from higher oil prices rather than suffering from them. Singapore, with its position as a regional financial hub and its strategic reserves, also shows relative resilience compared to pure energy importers. Currency pair to watch in the yellow scenario, the US dollar against the Indian rupee. Every dollar rise in oil adds approximately $150 million to India's monthly import bill. The rupee weakens. Real purchasing power for India's vast diaspora erodes quietly. The red scenario. The ceasefire expires Wednesday with no extension. The conflict resumes. This is the scenario the market has been pricing as unlikely, but it is not off the table. The ceasefire has already been violated multiple times by both sides. The US seized an Iranian vessel this morning. Iran fired on ships over the weekend. The gap between what each side is willing to accept remains wide. In the red scenario, the EIA's second quarter peak forecast of $115 would likely be exceeded. Some Wall Street analysts have modeled scenarios toward $150 per barrel. At that price, the economic impact across Asia becomes severe. Vietnam, with 20 days of fuel reserves, faces genuine shortage risk, not just price pressure. Indonesia faces similar constraints. The Philippines had already declared a national energy emergency. The currency impact would be significant. The Korean won, Thai baht, Philippine peso, and Indian rupee would all face additional depreciation pressure as energy import bills surge and capital flows to dollar-denominated safety. In this scenario, analysts note that gold, which has already reached $4,700 per ounce, would likely continue its record run as the primary safe haven asset. The US dollar would strengthen. Malaysian assets would continue to outperform within the regional context. Lorraine Tan at Morningstar framed the underlying dynamic clearly. South Korea's stock market is, in her words, particularly sensitive to swings in oil prices, meaning geopolitical shocks in the Middle East tend to trigger short-term volatility. Short-term. That word carries a lot of weight right now. Here is what you should be watching in the next 72 hours, because that is the window that matters most. Watch Indicator 1, whether talks actually begin today in Islamabad. Not whether they are announced, whether they actually begin. Iran has not publicly confirmed attendance as of this morning. If delegations are physically in the room by end of day Monday, the probability of a ceasefire extension rises significantly. Watch Indicator 2, the Strait tanker count. Go to marinetraffic.com, search the Strait of Hormuz. If you see 0 or 1 vessels attempting transit, the blockade is holding. If you start seeing 5, 10, 20 vessels moving freely, that is a stronger signal than any press release. Watch Indicator 3, Wednesday's ceasefire expiry deadline. If no extension is announced by Tuesday evening Singapore time, prepare for a significant market reaction at Wednesday's open. That is the moment of maximum volatility risk this week. The oil market right now is not trading on fundamentals. It is trading on 48-hour geopolitical windows, which means this week, every morning before markets open, you want to know two things. Is the strait open? And are people talking? If both answers are yes, the green scenario comes closer. If either answer is no, the red scenario becomes the working assumption. The world is watching Islamabad this week. Asia has more riding on it than anywhere else. One question for the comments. Do you think a deal gets done before Wednesday? Or does this crisis have further to run? Let me know where you stand. I read every reply.